Hello and welcome. Today, we're going to tackle a question that trips up even experienced investors. It's a real paradox. How can a company's stock price be falling when the business itself seems stronger than ever? We're going to unpack this because, believe it or not, this confusion can be a massive signpost for a huge opportunity. Right, let's jump straight into it. We're going to use Visa as our case study today because, honestly, what's been happening with them is a perfect example of this disconnect. You've got these rock-solid results on one side and a super nervous market on the other. Understanding this is key to figuring out how the market really works. So here's our roadmap. First, we'll define the paradox itself. Then, we'll dive into Visa's incredible growth numbers. After that, we'll look at the wall of uncertainty that's freaking investors out, see how that fear actually creates opportunity, and then wrap it all up with a really powerful concept, the asymmetrical investment. Okay, so what in the world is this Visa paradigm? Well, at its core, it's this classic tug-of-war between the hard, cold facts of a company's amazing performance and the emotional, often fearful, feelings of the market. And this slide just lays it out perfectly. On the left, you've got a business that is absolutely firing on all cylinders. We're talking record results, smart moves, the whole deal. But on the right, a stock price that's been getting crushed, even hitting 52-week lows. It's pure pessimism. So just how good are the fundamentals? Let's get into the numbers. And let me tell you, these numbers paint a picture of an absolute financial powerhouse. Calling Visa a growth machine really isn't an exaggeration. The data totally backs it up. First off, get this. In the first quarter of 2026 alone, Visa raked in nearly $11 billion in revenue. That's a 15% jump from the year before, and it completely blew past what the analysts on Wall Street were predicting. This is not a business that's slowing down. So how'd they do it? By processing almost 70 billion, that's billion with a B, transactions in one quarter. That's up 9%, which tells you that even with all the talk about a shaky economy, people are still out there swiping and tapping, and they're using Visa's network to do it. And this is where it gets really interesting. This shows that Visa is so much more than just a payments company now. Their high-margin services, things like data analytics and fraud protection, grew by an incredible 28%. In fact, that one area was responsible for half of their total revenue growth. Wow. And what do they do with all that cash? Well, they give it back to the owners of the company, the shareholders. In just 3 months, they returned over $5 billion through stock buybacks and dividends. The business isn't just growing, it is a straight-up cash-generating machine. Which, of course, brings us to the big question. If the business is this good, why is the stock falling? It's because the market has built what you could call a wall of uncertainty around the company. Now, this pessimism isn't coming from nowhere. There are some real concerns here. Governments in both the US and the UK are looking really closely at Visa's fee structures. The company also said its own expenses might rise a bit faster than investors liked. And then you layer on top the usual stuff, global politics, economic jitters, and of course, the constant threat of new fintech startups. And this just shows you how finicky the market can be. That amazing 9% growth in transactions we just talked about, some analysts were hoping for 10%. That tiny 1% difference was enough to spook investors and make them worry that maybe, just maybe, Visa's best growth days are behind it. But here's the thing about market fear. It's nothing new. And for investors who can keep a level head and zoom out, these moments of widespread pessimism, they're often where the best opportunities are hiding. The legendary investor Ray Dalio put it perfectly. He basically argues that while the headlines and the details might change, the underlying patterns of how markets behave are always the same. So the best thing we can do is look at history. These cycles of fear are predictable, and so are the opportunities they create.
And history tells us something really important. You know, while the news loves to scream about doom and gloom, the actual data shows that the chances of a truly terrible, lost decade, where the market goes nowhere for 10 years, is incredibly low. We're talking just a 7% chance. That means that making decisions based on panic is statistically almost always the wrong move.
So this brings us to the big payoff. This exact situation, a fantastic company facing temporary emotional fears, is what creates the holy grail for smart investors. It's a concept we've actually talked about before, and it's called an asymmetric investment. This is where your potential for reward massively outweighs your potential for risk. Let's be crystal clear about what this means. An asymmetric opportunity isn't just a good deal. It's a special situation where your downside is limited, but your upside could be huge. And it happens when short-term fear pushes the price of a really high-quality asset way below what it's truly worth. And Visa, right now, is a textbook example. Let's just walk through the steps. 1. You have the foundation, a dominant, super profitable business. 2. You have the catalyst, all these temporary fears about regulations and costs that have pushed the stock price down. And that creates step 3, the chance to buy a world-class company while it's on sale. And you can literally see that discount right here on this chart. This shows the price-to-earnings ratio. It's basically how much investors are willing to pay for $1 of Visa's profit. Historically, they've been happy to pay $36. Today, because of all that fear, you can buy that same dollar of profit for just $23. That's near a 5-year low, even while the business itself just keeps getting stronger. And this isn't some wild fringe theory. Remember Ray Dalio? His fund, one of the biggest in the world, has a $180 million position in Visa. They are putting serious money behind this exact idea, that the market's fear is temporary, and the long-term value of the business is what will win out in the end. So the key takeaway from all of this is pretty simple, but it's incredibly powerful. The market's mood and the reality of a business are two different things. And when fear creates a huge gap between them for a great company, it creates a rare asymmetric opportunity. The downside is cushioned by the strong business, but the upside is huge as the price eventually catches back up to reality. Which leaves us with one final crucial question. The market is just constantly screaming at you with news and opinions and panic. The most valuable skill you can ever develop is learning how to tune out all of that noise, focus on the real business fundamentals, and calmly identify the true signal. That's the key to making sense of it all.